Great. Well, good evening, everyone, and welcome to our seminar, which is entitled, Is Sustainable Finance Nothing More Than Woke Capitalism? I'm Rosemary Lister, the Professor of Climate and Environmental Law in the law school, and I also am the co-leader of a multidisciplinary initiative here at the university on climate disaster and adaptation, which is a sign of the times, isn't it? So this seminar, with a provocative title, is jointly hosted by the Australian Centre for Climate and Environmental Law and also the Ross Parsons Centre for Commercial, Corporate and Taxation Law. So I want to recognise that we meet on the lands of the Gadigal people of the Eora Nation, and I pay my respects to their elders past, present and emerging, and also acknowledge that this has been a place of teaching and learning about the environment and indeed the climate for tens of thousands of years. So to set the scene for this evening's discussion, just in case any of you are new to this field, I just wanted to set out the fact that Australia has really been at the forefront in many ways of sustainable finance, because over the past 3 decades, investors, banks, insurers, and financial planners have been building ESG into their governance and capacity in line with international best practice. So, for example, and some of these may be familiar to you, they were early signatories to UN and other similar initiatives like the UNEP Finance Initiative in the 1990s, the Principles of Responsible Investment in 2008, the Equator Principles for Project Finance, the Task Force on Climate-Related Disclosures, the Task Force for Nature-Related Disclosures, Net Zero Asset Owners and Managers Initiatives, the Responsible Investment Association Australasia, and the Investor Group on Climate Change. And as you may know, we have a very active shareholder activist movements with groups like ASA, Market Forces, for whom I have attended AGMs and made submissions on climate change, Get Up, Lock the Gates, industry super funds, and very powerful individuals like Mike Cannon-Brookes. So unfortunately, anti-ESG sentiment not dissimilar to that in the US was expressed by the previous coalition government, with initiatives to try to force banks to finance fossil fuel assets and to curtail the scope of proxy voting advisors. Now, this has been substituted with a more enlightened approach, in my view, by the new Labour government. And this was outlined in Treasurer Jim Chalmers' essay in the February Monthly magazine on his vision for a new values-based capitalism. And if you haven't read it, I do recommend that you do, because it does try to point the way forward for the Australian economy, but also for sustainable finance. And so in the context of all of these developments, in 2019, the finance sector rallied to establish the Australian Finance Initiative, and it published its roadmap in 2022 for a fairer, more inclusive and equitable and sustainable finance system. Now, this has now turned into the Sustainable Australian Financial Institute, and it has a mandate from the federal government to embark on a number of initiatives to transform the sector. And one of the most important of those is with the imprimatur of the Treasurer to label the climate impacts of different investments under a taxonomy. And this will help investors to align their choices with climate targets. So it's now my pleasure to introduce both of our speakers, and they're going to just speak one after the next. Zoe Bush is a senior solicitor in the Environmental Defenders Office, working particularly in their Safe Climate Corporate Program. And she's an adjunct lecturer, or has been, as I understand, Zoe, at the University of Western Australia Law School. She holds a Master of Laws from Columbia University, from which she graduated best in class in the Climate Change Law and Policy Unit. She started her career as an associate at the Federal Court before joining the State Solicitor's Office in WA. In 2019, she was awarded WA Junior Women Lawyer of the Year. Congratulations, Zoe. So Zoe has had a stellar and varied career so far, and I'm really looking forward to your presentation. Now, Jan Job de Vries Rob, JJ, as he prefers to be called, is senior counsel at the Dutch Development Bank. He has extensive experience in international finance, obtained in both private practice and in-house roles in Australia and the Netherlands. Now, he says while originally he specialized in structured finance, in his words, the dark side, he moved to international development finance in 2005, working across asset classes. He focuses on impact investing, sustainable finance, and human rights and climate litigation. He's been teaching at Sydney Law School for 15 years, but this year, for the very first time, in fact, starting today, right? Yes, starting today, he is teaching an international sustainable finance unit in our Master of Environmental program. And it's proved so successful that we've had to cap the numbers. If you can believe it, for the first time of running this course, he has already attracted 60 students. So thank you very much, JJ, for your contributions to our program. And so now I'm going to welcome first Zoe and then JJ to the podium. Thanks very much.
Great. Thank you so much, Rosemary, and thank you so much, JJ, as well, for inviting me to speak tonight. And thank you all for turning up on a very cold Monday evening. So that was a perfect introduction by Rosemary and perfect context in which, JJ and I really wanted to discuss this topic. We've obviously seen a lot of changes here in Australia in the last couple of years. And in the last 12 months, there's been a very strong anti-ESG backlash that has emerged in the US, which has prompted a lot of consideration here in Australia around the likelihood of that eventuating here. How do I make this? Okay, I'm not too sure how to make the clicker work. Is it just? Okay, great. Excellent. Thank you. Sorry, give me 2 seconds. Sorry, I've completely forgotten where I was going to start. But since 2021, we've seen more than 550 of the world's largest financial institutions, with 130 trillion US dollars in assets under their management, commit to join the Glasgow Financial Alliance for Net Zero in order to assist the transition to a net zero global economy. And so what we're witnessing at the moment is the rapid escalation of efforts to assess, manage and respond to climate-related risks, and the slow but steady reallocation of capital towards activities that are consistent with limiting warming to 1.5 degrees. And there's also an increasing understanding, and JJ's always reminds me of this, that ESG and sustainable finance aren't just confined to climate. At COP15, a group of institutional investors announced the formation of Nature Action 100 in order to drive urgent action on nature-related risks and dependencies in the companies that they own. But to some, this is nothing more than the pursuit of a woke agenda. And I don't think anyone's put it quite as strongly as Alabama's Attorney General when he accused an unelected cabal of global elites of using ESG to hijack the capitalist system, capture corporations, and threaten the hard-earned dollars of American workers. And so, as I mentioned at the beginning, in the last 12 months, we've seen a highly politicized attack by conservative US lawmakers on companies and regulators that are taking ESG, and particularly climate, seriously. So in February this year, congressional Republicans wrote to the chair of the US Securities Exchange Commission, accusing the chair of exceeding the commission's authority, this was in relation to the proposed requirements for climate-related financial disclosures. And they accused the chair of exceeding the commission's authority by proposing those requirements in pursuit of a progressive social agenda. And a month earlier, 25 attorneys general from Republican states filed court proceedings seeking to block a Department of Labor rule that would merely allow fiduciaries to consider ESG factors when selecting retirement investments and exercising shareholder rights. And in 18 US states, we've seen legislation cut the other way. So legislation that would penalise businesses who are considering ESG factors. And that legislation has taken many forms, but primarily it's involved prohibitions on those states doing business with or investing in entities that have divested from fossil fuels. And the attack hasn't been confined to government or regulatory actions. So in August last year, 19 attorneys general from Republican states sent a letter to the world's largest asset manager, as I'm sure we all know, BlackRock, expressing concerns that, I'll quote, its coordinated conduct with other financial institutions to impose net zero gave rise to potential antitrust concerns. And a number of those states have since withdrawn their assets from BlackRock's management. And topically, given that we're being hosted by a Sydney Law School and that I myself am a lawyer, law firms haven't escaped the fray. So in November last year, Senate Republicans wrote to 51 commercial law firms, including firms that have a presence here in Australia, expressing concern that to the extent that they're advising clients on their participation in ESG initiatives, that those initiatives may constitute antitrust violations and that those firms should preserve any documents in anticipation of future investigations. And so all of this puts companies and financial institutions between a rock and a hard place, because on the one hand, ESG matters are now core financial, reputational and legal risks for companies that have left unaddressed, expose them to significant financial losses, increased costs of accessing finance and liability risks. But on the other hand, they now face the risk of potential legal challenges and boycotts by jurisdictions that are politicising their ESG actions. And there's reason to think that this is already having a chilling effect on entities' ESG ambitions. So after the antitrust letters were sent to BlackRock and to commercial law firms, a number of participants in the Glasgow Financial Alliance for Net Zero that I mentioned earlier started withdrawing from that alliance, citing antitrust concerns. And in order to stem the tide of defections, Mark Carney, the co-chair of that alliance, told members that they would no longer need to comply with the Race to Zero, which is a UN initiative that requires signatories to phase out fossil fuels. And while we've, as Rosemary mentioned, we've had our own version of the anti-ESG movement under the previous coalition government, we haven't seen something quite as concerted as what we are witnessing in the US. But there is reason to think that it's already having its effect. The effects are being felt here. So while I'm sure many of you have probably heard of greenwashing, so entities overstating or misrepresenting their ESG credentials, in the last 6 months in Australia, we've really started noticing a trend of green hushing, and that's particularly in relation to super funds who are coming under increasing scrutiny for in particular, saying that they were Paris aligned or had net zero ambitions, despite continuing to invest in fossil fuels. And as a result, we've seen those super funds start withdrawing the disclosure of climate-related information or climate-related targets, and again, due to perceived liability risks. And all of this is the exact opposite of what we need to be occurring if we're going to keep warming within safer limits, and we're going to achieve the rapid and significant reallocation of capital that's going to be required to do so. So I'm sure I'm telling you something something you all know when I say in 2015, obviously 196 countries, including Australia, committed to the Paris Agreement's goal of limiting warming to well below 2 degrees with ambitions for 1.5. And we are perilously close to breaching those targets. Australia has already reached 1.4 degrees of warming. And I actually saw just a few days ago that the IPCC published that they expect the world will breach 1.5 in the next 5 years. And according to and already, well, for people that have been living in New South Wales for the last few years, I don't need to tell you that that's already been wreaking a fair amount of havoc. We went from some of the worst bushfires this country has ever seen into a pandemic, when pandemics are made more likely due to biodiversity loss because of the increased rate of novel species interactions, into a couple of years of severe flooding. And it will only, unfortunately, get worse. So according to a recent decision of the federal court in Sharma, which I'm sure many of you are aware of, the federal court found that if warming reaches 4 degrees, most of Australia will be uninhabitable for humans. The southeast and southwest agricultural zones will be largely unviable, leading to food shortages and mass migrations from the regions to the cities. In those cities, we'll be experiencing increasing inundation and flooding due to storm surges and sea level rise, and most of our beautiful eucalypt forests will be gone due to repeated severe bushfires. What was particularly alarming about the unchallenged evidence that was accepted by the federal court in that case was that as we near 2 degrees of warming, we will reach a point where any amount of extra greenhouse gases in our atmosphere could send us on an irreversible trajectory to that 4-degree world. So, let that sink in. We are already at 1.4 degrees. And as we near 2 degrees, we will reach a point where any extra emissions could give us a one-way ticket to that world that I just described. And indeed, scientists are increasingly concerned that some of the tipping points that could send us on that trajectory may have already been reached. But let's put that all to one side at the moment. And in my mind, that's an incredibly risky field experiment to do. But bear with me. Is the anti-ESG move backlash economically justified? And naysayers may and do point to skyrocketing fossil fuel profits as proof that the pursuit of ESG objectives comes at the expense of shareholder value and bottom lines. But that's obviously a very short-sighted argument. As many of us would know, the spike that we've seen in fossil fuel prices and profits is primarily due to the energy shortages caused by the Ukraine war, and investors are valuing it accordingly. So take the tale of 3 energy and resources companies: Anglo American, Rio Tinto, and Glencore. As you'll see from that slide, in 2018, all 3 companies had a fairly similar share price. Then in 2018, Rio Tinto, which is represented by the orange line, the middle orange line, entirely exited coal. Anglo American, which is represented by the top blue line, in 2021, created a separate entity to manage its coal assets. And Glencore, represented by the bottom aqua, would we describe that as aqua? Aqua line, has coal in its portfolio, still has coal in its portfolio. Indeed, I'm pretty sure it's most, if not all, coal. And it proposes to run that down responsibly over time. Now, Glencore's obviously done exceedingly well off the back of the spike in coal prices, and last year had a record gross earnings of $34 billion. And you'll see that that's translated into its share price. So you'll see from that around the beginning of 2022, its share price begins to peak in reflection of that. Nonetheless, Rio Tinto and Anglo American share prices have otherwise consistently outperformed Glencore since 2018, and even now Rio Tinto and Glencore remain about the same, and Anglo American is still outperforming it. And what that suggests to us is that investors back Rio Tinto and Anglo American strategies over Rio's. And that narrative is consistent with the data that we're seeing. So recently, the New York University Stern Center for Sustainable Business conducted a review of 1,000 empirical studies into the relationship between ESG performance and considerations and financial performance of listed companies, and it confirmed that sustainability initiatives at corporations are correlated with better financial performance. And that's also consistent with Australians' perceptions. So a recent survey that was cited by ASIC just in a media release just a couple of weeks ago, a survey they conducted last year found that 62% of the Australians surveyed believe that ethical super funds perform better in the long term than those that aren't. And that's up from just 29% of people holding that view when ASIC conducted that survey in 2017. And so, so in my view, when conservative US lawmakers discredit ESG, it's not anti-woke, it's bad business. And it's telling that the anti-ESG backlash in the US has been a conservative one. You know, as you will have seen from my summary earlier, it has all been from within the Republican Party. And rather than being a movement that's come from investors, we're concerned about the erosion of shareholder value. Because what they're implying is that large parts of the $130 trillion US dollar financial industry that have committed to net zero have been hijacked by leftists. And anyone that's familiar with those individuals would bring a healthy amount of skepticism to that claim. And I think this is actually perfectly illustrated by the comments of Rio Tinto's chairman at Rio's AGM just 2 weeks ago. And I'll let him just speak for himself here. I'll play this. Oh, thank you.
Scourge so as to focus on long-term shareholder value creation. These ESG zealots do not represent the interests of the small shareholder.
Well, first of all, I wouldn't mind introducing some people in the session together on this, but I actually have a very different view. I think that impeccable ESG and long-term shareholder value are very consistent. They go together. You don't have long-term shareholder value if you aren't impeccable on your ESG. I do not believe it's a trade-off. They're complementary. I think the biggest challenge for, as I mentioned in my remarks, is within ESG, when we have this drive for wanting to find more of the materials for the energy transition, and then we have the social license for the people where that mining is going to affect them more directly. That's where I think we have the biggest challenges. So our message is why our whole strategy is actually anchored in this on the climate transition, the energy transition, is because it will create a lot of shareholder value. And I have to say one other topic. If you think I'm just in case you think I'm a bit soft on the capitalism, I believe I'm a hardcore capitalist, and I would just refer to Adam Smith in his first book that he wrote called The Theory of Moral Sentiments. He said in that book, it's the duty of the entrepreneur to take care of the society in which they operate. It's kind of a broad-minded view, and I very much subscribe to that, and I think we all do.
Thank you. I think what's so effective about that answer, which I think is just from a week and a half ago at Rio's AGM, what's so effective about it, I think, is that it speaks in the language of and to the interests of the shareholders that ask that question. Because what that question does reveal is that while we haven't experienced such a highly politicized anti-ESG backlash has occurred in the US, is that there remain investors who aren't convinced that the pursuit of ESG objectives are in their best interests. And so the challenge for us, those who, like Rio Tinto's chairman, are convinced that ESG is in our best interests, the pursuit of ESG objectives is in our best interests, is to meet people where they're at and to speak to their values and interests and concerns. And the beauty, and you'll notice that in this presentation, I've approached sustainable finance and ESG investing both through the lens of its importance for keeping warming within safer limits and avoiding catastrophic climate change, and also through the economic aspects of it. And the beauty of ESG now is that we're now fortunately at a place, well, it's the economics of it are such that we can speak in both languages. We can speak in all of those languages. And maybe JJ is going to go off against this, but, and so, and the proof is really in the, oh no, we don't want to listen to it. Despite recent conservative opposition, analysts expect that ESG investments will almost double in the next 3 years to $34 trillion. And that's not an aberration of free market principles, but a reflection of them. And so now our responsibility is to take people on that journey. So if we want to avoid an ESG backlash similar to what we've seen in the United States. And now I'll hand over to JJ so he can provide us with an EU perspective.
Yeah, that's okay. So while JJ is having a break, are there any questions that you would like to ask our third?
Yes, yeah. Hello.
I've heard the antitrust criticism, for some time.
Yes.
But one I saw recently was companies claiming that they couldn't divest or not invest in coal companies because of discrimination law. And I'm wondering if you've seen that one. That's also coming out of the US at the moment.
No, I haven't seen that one. Do you know, is that coming also from Republicans or attorney generals, or?
It was a company saying that they couldn't discriminate that they had no basis in which to discriminate.
Yeah, no, it is. I have actually heard of a claim, and I haven't actually been able to obtain a copy of this claim. My understanding is that it was settled before it went anywhere near a court. So I unfortunately haven't been able to obtain a copy of this pleading. And it wasn't climate related, but it was broader ESG in that it concerned firearms. And it's obviously a very United States issue. And it was concerning someone who had a lease and who had a tenant detained a lease, and the purpose of it was a sort of firearms factory or something along those lines. And the landlord became aware of the purpose for which they intended. So the lease was signed, moved in, they'd renovated the place, incurred expenses. Landlord became aware of the purpose for which they intended to use the factory, and then had an ESG policy that wouldn't allow them to do that, and so kicked the tenant out, and the tenant then commenced proceedings. And I think part of the claim, again, I haven't seen the pleading, but how it was reported was that it was partly based on a discrimination argument, an anti-discrimination argument. So I think there's lots of really interesting legal arguments that if we're going to see anti-ESG pick up pace, we might see in Australia. I think another one we could see is obviously that if there was going to be an anti-ESG legal proceeding, in addition to anti-competition claims, is also that it's not that a director or directors haven't acted in the best interests of the company by prioritising ESG objectives allegedly over the pursuit of shareholder value. So, yeah, the discrimination one's a really interesting one. I'd be very interested in if you've heard about any other discrimination ones in the US. Yeah, I'd love to see it. Yes.
Tim Boley, Monash University. I was really fascinated in the green hushing you referred to, and just wondered if you might expand a little more on what is behind that in the Australian context, because we have a more favourable political context here than the US, and our industry super funds in particular have been really sort of at the forefront of the ESG push here. So what's causing them to pull back, do you think?
Yeah, okay. Well, I'll qualify my answer with it's entirely speculation, because I don't sit on a super fund and I don't know. I send the letters to the super funds. I think, look, and I do have some insight in relation to one of them, because it was a super fund that one of our clients had been engaging with on a regular basis in relation to the ESG claims. And this is public knowledge. The letters are published, so I can talk about it in a bit of detail. So our clients were concerned that super fund made representations that it was Paris aligned, that and was nonetheless investing in a number of fossil fuel companies and fossil fuel companies that were expanding fossil fuel production, which obviously in light of the latest IEA Net Zero by 2050 report, new IPCC reports tell us that there can't be any new fossil fuel projects. We're going to keep warming within the Paris Agreement temperature goals. And so on that basis, our client was concerned that that was misleading. That super fund did actually divest from a number of fossil fuel companies as a result of that, which was a great result for our client. They then unfortunately proceeded to remove, they previously had an emissions reduction target, not an emissions reduction target, but a ambition in relation to their financed emissions and who they would that had net zero portfolio emissions by a certain date. And they've since removed that target and a number of other climate-related disclosures. It's unclear yet whether it's a good thing in the sense that they're going away, making sure, like doing a thorough check, and they plan to republish it when they're satisfied that it's all sound and accurate, or whether that represents a ratcheting down of climate ambition, which would be concerning. So my understanding is that it's primarily to do with perceived liability risks, because obviously we now have the Senate's conducting an inquiry into greenwashing. ASIC's just been given additional $4 million to crack down on greenwashing, commence its first proceeding for greenwashing in February. And so I think there is a real concern about potential liability risks associated with the publication of climate information. And it's a concerning development in Australia. If it represents a ratcheting down of climate ambition, I think that's really concerning. And to some extent, obviously, Treasury released this consultation paper just at the end of December last year about a mandatory climate disclosure framework for climate-related matters. And to some extent, that would help address the problem, because especially if they're going to adopt a more comprehensive voluntary framework like the ISSB draft standards, which requires entities to disclose climate-related targets and the extent to which they're consistent with Paris, etc. Then if entities are required to do that, then it'll mitigate that green hushing issue. But it's an interesting space, and it's an interesting one to watch. I'm not sure where it will go. No, pleasure. JJ.
Magic. And there's another one. Yeah. That's the one. So, first of all, thank you for coming. Thank you for being here. Thank you, Rosemary. Thank you. So it took me 15 years to get to the common room, I think. But it's I think just the formal part is what I'm saying is my own views and not that of my company. I work with the Dutch Development Bank, have been for a number of years. So my perspective is really on Europe, and it's on development finance. So to be honest, I was struggling a little bit with the topic, but I think it's a great way to reason to engage with you on sustainable finance and, frankly, some of the challenges that we face in Europe. So forgive me if I go for my slides and just share with you my insights on where we stand. I looked at this fantastic slide from the way that the Americans are looking at it. I think my first observation is, and I'm filling in, is that people tend to think of Europe as being the leader that knows all about sustainability and ESG and is on this path which is well thought through, and it has a clear idea of where we're going. And I see some slight shaking of the heads already. And I think coming from Europe, I can say that's basically a fallacy. Because I see, and that's not a really very positive picture to paint, I see a polycrisis. I see a continent in crisis, which is hopping from one to the next. I see governments, a lot of governments, which really are weak governments, where there is some positive in the sense that there's been so much focus on getting this green agenda going. And it's a bit like when the train is riding, it's also more difficult to stop it. So there's a lot of initiatives, and I think if we think about the disclosure, SFDR is one of the big achievements there. So there's a lot of good things happening, but I see quite a few threats on not just on the horizon, but actually quite close. I think one of them is purely on the business side. And what I mean by that is the actual level of bureaucracy that is caused by the disclosure regulation is really impacting business in a negative sense. It's more than just a cost issue. Where those who are kind of married to the green idea might say, well, that's part of it. We just have to go and invest here. But I also look at it from the perspective of developing countries. And what I see there is that the level of regulation that Europe is creating is actually making development finance more difficult. If you look at the taxonomy, if you look at the requirements that we're imposing, and as a result, we expect developing nations who need our money for projects to be funded to align with that. And that's simply a very tough act to carry. I've been working on some deals on the likes of Mongolia and Southeast Asia, where we find that the lack of infrastructure on specifically the regulatory part, or the infrastructure on also supervisory part, is a big gap. And it takes more than just technical assistance to get people across the line to facilitate that. So my perspective is that it's really hampering development finance, which I would argue should never have been the intention in the first place. So that's not a very positive message. I think there's also, but let me put it in a bit of context, because the positive view that I have here is that we're in the middle of a transition, and we're perhaps a bit further on that track than Australia is. But you'll be better judge of that. And with being in the middle of a transition, it fits to be a bit in chaos. So in that sense, chaos is actually good. That's what I mentioned to my students this morning. I may be throwing the kitchen sink at you, but that's a good thing, because I'm making you think. Now, why the chaos? Why the challenge? And I think I've got some slides to kind of give you a feel. First of all, I asked actually ChatGPT what the difference between sustainable finance and woke capitalism was. I'll just save that for a bit. So this is the one I wanted to. So are we really embracing ESG? Well, the reason for putting up this list of those is I feel we're a bit like on that edge, where it looks like we've really done a lot of initiatives which have kind of been followed by the markets. And I see other countries following the example, if I think of the taxonomy. But I see the dangers. So first of all, for developing nations, but also within Europe. And so that's the context. Hopefully that works. Anyway, I'll continue in a fine way. No, I did want to share that. Just when you woke up, when you woke up here. So part of that chaos is if you will, the same polarization that we see in the US. How you see I would almost say the weaponization of the ESG issue, and whether you call it woke or not doesn't really answer it. It's not anymore about what it is. It's you give it a name, and you kind of it's actually a fantastic PR thing. You create something, you call it woke. Nobody knows what it is, and it acts as a rallying cry for everyone who is against something. So I think that's what's happening back home. So just again, context. These are, you might have read about the farmer protests in back home. So this is in the middle of that transition. We have a country which has been focusing on intensive agriculture for, I don't know, 50 years or more since the Second World War. And we're realizing it is destroying our environments, our natural resources. So if you will, where the challenges that you painted is on climate, in ours it is on the environment. And we've really did it ourselves. So the reason I'm putting out these flags here is because that has become the symbol of protests. And I'm trying to draw a parallel by the protest that the Dutch farmers are doing and the way in which the US senators are doing it. Do you see anything particular about the Dutch flag? I won't take it harsh if you don't. It's upside down. And I mean, can you imagine taking something that people would pride themselves on, turning it upside down? You, whichever road you might travel on, you would see those flags. And it's become the rallying cry against the government, a very weak government, I might add, as in everything that you oppose. And I think that's the parallel with woke. I mean, no one knows what woke is. I think ChatGPT, when I look at ChatGPT, my conclusion was woke is being described as presenting yourself as being more, taking certain values into consideration that actually you're not, more social values than actually you're not. So actually it sounded like greenwashing. So if woke is greenwashing, I think we all agree that's something we don't want, and we're against that. But the parallel is the strength of having a rally cry and see that that is uniting, in this case, populism. I think that's a very strong, the right word is, it's a significant threat against what I would call the green agenda. So I think that's a key point I wanted to get across, and just turn it. So this was from the RIA. I'll leave that for now. But I put RIA on there, I think that was last week, when the discussion about woke and whether that would fit in Australia was actually framed in the context of just transition. And what I mean by that is, it's, if you think back of the description that the senator gave, it was actually about appealing to the hearts and minds of the ordinary American, as if he or she was being attacked, and probably white, middle-aged Americans being left behind. And to my mind, there's a great parallel to what actually the transition is trying to achieve. And that is not leaving anyone behind, the just transition. So if I combine those things together, it's not no greenwash and a just transition. We actually have the systems in place, the arguments in place for a successful transition. But we have a very strong I wouldn't say anti-ESG, but very angry populace. And that's just a remainder of the pandemic. So having said all that, my conclusion is not a real conclusion. It's to give you a feel of what comes next. So hopefully kind of perhaps challenge or give ideas. It's about NGOs and students. Of course, with having you here, NGOs, I think in the face of the weakness of government, what I see is that NGOs in Europe are stepping into this place very strongly. Is there evidence of that? Well, think of, for instance, when Shell doubled down on oil, changing their strategy, and BP to continue and to take more oil out of the earth. The NGOs suing them on personal liability. You might have heard that was initially dismissed, but I think that's a clear case of strategic litigation, taking the risk that your case might not win, but you think it's so important that you actually have the guts to put it out there in the public domain. Very strong case. And the other one, I think if we think about what's coming next, and it was an idea that you I think also kind of had discussed with someone, and that is the focus in sustainable finance or in strategic litigation is now on financial institutions as holding the tap for fossil fuels. But what I'm increasingly seeing is that there is the generation that I engage with, my students, are going beyond that. And one of the points coming up was actually not just looking at financial institutions, but also those who advise financial institutions, and in particularly law firms. Having been at a law firm, I feel at liberty to say this. And to say, well, isn't it time to start measuring what law firms are doing, what their impact is? So the deals that they work on, and start charting that in the same way that I think it was Yale that is charting what European businesses are doing, whether they're actually exiting Russia or not. So a full project. And I think that's one of the next spaces where I would expect law firms, I'm expecting them to change their behavior. Not because I say so, but because if they don't, I would expect them to actually lose their talent. Not all of it, but definitely a lot. So that's one of the challenging thoughts that I would leave you with, and forgive me for straying here and there. But I think my key point was to share with you a sentiment of what is going on in Europe. And it's not that perhaps that what you expect, that kind of straight path. We're in polycrisis, we're burning, but what brings us together is the urgency to act upon it. So thank you.
Thank you. Time for a few questions.
Yeah.
May I make a comment and ask a question?
Yes, of course.
So my first comment is I do work with super funds and I can assure you that they're not actually dialing back what they're doing. They're just dialing back what they're saying because they are concerned. Actually, I think that's a good thing, because actually the biggest danger is that we all thought that we were looking after it, and then we discover we're Thelma and Louising off the edge of your cliff, which would not be good. So I actually think that's a positive thing. We just have to keep the pressure up. But what I wanted to talk, I'm really impressed with both presentations, but JJ, what I really liked about yours, economists often talk about growth in stuff, but it seems to me that although growth's important, distribution of wealth and distribution of opportunity is something that's so important. We're seeing it within countries, and you're seeing it in terms of developing countries. I just wonder if you could talk a bit more about where you think, you talked about the just transition, but I think there's more to it maybe.
Yeah. In terms of,
question, I'm not sure.
Yeah. In terms of how the transition is impacting developing countries, is that what you're looking at?
I'm just thinking generally, we need to think about how the pain, how the opportunity is spread across society, the world.
Yeah, actually, I think it's too many angles here. I think one of my themes was weak government, just transition, and kind of ensuring that everyone has their goal, their opportunity. I think what I see in the market is that actually the market is stepping in and it is defining what is sustainable, what has become sustainable finance. Actually, what we do probably 20 years ago, we all call sustainable. I think soft law principle has basically taken over the role of government. And that has made it possible to create, to a certain degree, still do safely the deals that we want with. And talked about the challenge of getting money to where it needs to go. Part of that is to green resources, renewable resources, and part of it is to actually the places that need it most. But to do that, you need a safe environment. And what I'm seeing is a lack of, whichever reasons, a lack of safety on the regulatory side, which has been kind of implemented, which has been kind of filled in by the market itself. But that market has a self-serving interest. And that's, I just goes probably beyond this to look to discuss sustainability linked products. But what I'm seeing is when there's a lack of certainty, when there's a lack of real regulation, that's where concepts such as greenwashing still come to the fore. And that will really hamper the development finance as well as sustainable finance. Yeah.
Okay, well, do either of you have any concluding thoughts that you wanted to make? You've given us a fantastic presentation. Any last thoughts to share with us?
Yeah, one observation. I love the example of the AGM. And I think that the example closest back home is Rabobank, which I'm sure you're familiar with. They had their recent AGM, and we had famous Dutch, at least in Holland, famous actress who kind of took her role as a climate activist and challenged the CEO. But what was really interesting was to see that Rabobank was not framed for financing fossil fuels, but was targeted for basically financing agriculture and being responsible for nitrogen emissions. And I thought, well, so in the same way you might have read about this case of a Peruvian farmer who's suing a German utility, arguing that it is responsible for, 0.25 damages of all the climate emissions. And in the same way, we see here, if you will, a move towards another space, and that is agriculture. And I wouldn't be surprised if I'm not sure how that applies to the city.
So I think that is connected to, when we talk about ESG being brought up in climate, which you always know. I think that we can expect a real focus, especially in at the task force and related financial response to climate in September this year. And aware of the opinion that exists in the ether, which is, we had the opinion on climate related risks, and that will be more discussion around those obligations.
Great. Well, thank you both again. Thank you so much for your presentation. Thanks to all of you for coming along and for your questions. And that's it. Yeah.
Okay.